Welcome to my channel. I'm the covered call guy, and this is my journey to creating a $120,000 per year passive income portfolio. My portfolio currently yields about $70,000 a year, just about $6,000 per month, up from $61,000 when we started the channel. So I'll be reaching my goals using only covered call ETFs. And when I reach my goal, or before I reach my goal, comment, let me know where I should pivot, where I should stay with covered call ETFs. I'm not selling my covered call ETFs. When I reach my goal, I'm just gonna, the extra income I might have, I might buy single stock. I might go into growth, or you think I should go into real estate. I'm open-minded to everything, so let me know. Before we get started, legal disclaimer: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involves risk, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions. I'm just some random idiot you found online, and I could be completely wrong. All right, with that out the way, today we'll be discussing a very up and coming, or popular, getting traction on Reddit, X, formerly known as Twitter, and on YouTube. We are going to be talking about NestYield covered call ETFs. This report took me a while because I was doing a due diligence report on all three ETFs that they offer, EGGY, EGGS, and EGGQ. So let's get started. I hope you guys find this educational. This has been on my watch list, so I've been wanting to start this too. All right, let's get into a deep dive into this. All right, let's start off with their perspectives. At a glance, what do we see? Strategy and objectives. The management is actively managed and non-diversified. The structure, tripartite management. So it's title, next egg, and EGGY uses an equity profile plus options overlay. Right. EGGY's goal is high current income. EGG's goal is income plus downside hedging, and EGGQ is long-term growth. So each has a specific goal in mind. They don't have they're very what's the word? Not binary. One-sided, right? They're not binary. They don't have that um let's see. If it just aim for high current income, that's all it aim for. So there's definitely huge cons to that. Just as EGG's goal is income plus downside hedging. So there's of course downside to that, and of course EGGQ's goal is just long-term growth, and of course there's downside to that. So key risks and costs, right? The net expense ratio is 0.89 after I think the 0.06 waiver. I don't know how long that's lasting. Typically they go up to a year, so maybe ending 2025 to 26 it will be no longer available. It is non-diversified risk, extreme portfolio concentration, about 10 to 25 stocks. Derivative risk strategy relies on complex call options, call puts, and spreads. It is a new fund, limited operating history, inception of 12/26/2024. So just coming up on a year. So it is new, but we will have a year of data. So that's why I have it on my watch list. I typically like to see at least one full year before getting my foot in these ETFs. And again, sometimes you might want to nibble like I do and get 10, 20, whatever, however, or typically I put anywhere from $1,000 to $5,000 and just see how it operates, and then if it performs well, then in both an up and down market. Right now we have in a bull market, so I don't have much clear information, and that's why I just like to nibble. All right, the yield story: EGGY versus EGGS. EGGY is a dynamic income, right? Versus EGG, it is a total return guard, as previously before, right? So it advertises a rate of almost 18%. The 30-day SEC yield is minus 66%, so that is concerning. Advertised yield of almost 14% with a 30-day SEC yield as of November 7, minus 0.50%. So that is concerning. Or we have to look the whole picture. We're not sure yet. It could be just because it's in a down market, right? So we have to see how that performs. And then the yield story for EGGQ and return of capital, right? EGGQ is the growth. They nicknamed it the visionary. So the growth stock focused on the same disconnect, right? We reported trailing 12 months of 4.3%, but the 30-day SEC yield is negative 0.57%, right? So what is ROC? Since expenses exceed income, negative SEC yield distribution, or paid from option premiums. This is ROC, not profit or dividends. It is fund returning your own principal to you. Again, they use it as a tax deferral strategy. This distribution are tax-free, but lower your cost basis, deferring your tax until you sell. All right. The fund claims that they'll try to aim for 100% ROC. And then we have to ask ourselves, right, is this ROC strategy good or bad? Why it can be good as a tax strategy? It is a tool designed for a specific purpose. It creates a tax-free cash flow. It defers taxes, right? You pay capital gains tax later when you sell instead of income tax now. Best for investors in a high tax bracket using taxable brokerage account. Or if you're not I just say high tax bracket, but it's great for everyone, even if you're not in a high tax one. But ideally, if you are in a high tax bracket, it's just you don't want to be taxed even more, right? So why it can be bad, right? Capital erosion. That's one thing we have to look at. That's one of the easiest way to know if it's bad return of capital. If it's consistently paying out tax deferred income, but the NAV is being destroyed, right? Then it can be misunderstood and misused. It is not a profit. The fund is literally returning your own capital while eroding your capital base, which can be destructive if the fund's NAV is also falling, right? Worse for investors in tax exempt account. Get no benefit and just erodes their compounding base. Verdict. Is NestYield ROC good or bad? So far, 2025 year to date, it has been good. It has been non-destructive, right? Based on the year-to-date data, the ROC has been non-destructive. That's good. We like that. We love that. I absolutely love that, right? Total return has been plus 27 to plus 35, depending on which one you held. Has been greater than the distribution yield. That is always good. That's one thing we look out for. This means the fund's NAV has also increased, right? Capital appreciation plus a high payout. Oh, that's a win-win. There is no loss there. Absolutely not. That is the best you can ask for, right? Investors receive tax-deferred cash and capital appreciation, right? The risk, the future, we don't know, right? So this positive performance is over a very short period, under 1 year, in a strong bull market for tech, which is why I'm nibbling, right? We have less than 1 year of data, and just because it's doing well for these couple of months does not mean it's going to do well in a flat or bear market, right? The funds would still have to pay its distribution, and if it's high, right, it's going to be start eating away and eroding my capital appreciation. All right, if the NAV is falling, this becomes destructive. Okay, if it falls consistently, it becomes constructive. That means the fund is literally just returning your strength and principal to you, right? The strategy has only worked over this period, but it risk becomes destructive in a down market. Risk 1, extreme concentration, EGGY and EGGs, right? As you can see, the top 10 concentration in EGGY, right? Look at that, top 10 holds about 70% and the rest in 32%, right? And EGG's top 10 concentration, top 10 holds 65 and the rest holds about 34, right? Funds are legally diversified, holding in only 10 to 25 stocks in total. So that should set off some alarm bells, right? Because you don't, it holds up to 25. So that's like, the fund manager has to have picked really solid stocks and you have to have high convictions, right? So if 1 or 2, 3 goes out, then it completely flips your entire ETF. All right, risk 1, concentration for EGGQ and sector beats, right? EGGQ is the growth, right? The top 10 concentration is mostly in tech, and then the others is in communication services. Right, so the top 10 holds about 68, with the rest 31. So you got to see the concentration there is you have to look through the holdings and see if you love those underlyings. You have to believe in the active managers. Right. All right. Let's look inside EGGY's top 5. Right. So we have App Lovin, we have Broadcom, we have Robinhood, we have Nvidia, we have Palantir. And you're like, oh wow, it's great, excellent stocks. But yes, Palantir has been running like crazy. Right. So that's why the volatility, the tech market. Right. All of these are tech. All of them. Right. So once the tech market is over, bull run is over, and it starts rotating into growth or value or other speculative assets, what happens then? So something to think about. All right, comparative holdings, all holdings, all funds. So EGGY, EGGS, and EGGQ. All right, so you can see here it's not exactly really diversified, right? And Robinhood is not in the top 10 of EGGQ. So you can see here it's not really, I would say, like, pick one of the three, and then I wouldn't own all three. Personally, I wouldn't own all three, right? If I were to own, I would really pick one and see, okay, which one would actually the strategy holds the best, right? So again, I'm nibbling right now. I'm on my watch list, and I might start nibbling, and we'll see. I really want to see how this does in a down market. All right, strategy deep dive. EGGY versus EGGS. EGGY is a dynamic income. The primary goal is high current income, the pure income, right? If this is what you want, this is what you're aiming for. Their core call strategy is to write calls at the money or close to the money to maximize premiums, because that's the most that's the highest premium, and it's the highest payout when it's at the money. Upside potential. Sacrifice sells away most of all the stock's upside. Versus EGGS. EGGS is about the total return, right? That's the growth card, right? Primary goal is income plus capital appreciation. Their core strategy uses out of the money, which generates lower premiums. Upside seeks to retain a portion of a stock's appreciation, right? So let's look at EGGQ, the visionary, right? I'm pretty sure this is more visionary. When they say that, it's more they're speculating and choosing the long-term growth. All right, the visionary and performance proof. All right, EGGQ, the visionary, right? Oh, what happened here? Oh, okay. Primary goal is long-term growth. Secondary goal is current income, right? This strategy is the inverse of EGGY. Its option strategy is calibrated for upside participation, not income generation, right? The hedge is de-emphasized. This is basically a growth ETF, okay? So performance as proof, right? EGGY, EGGQ growth plus 35%, EGGY income plus 27. Worst drawdowns, EGGQ growth minus 22, and EGGY income minus 18 because of the buffer. Remember, income can offer buffer. So let's look at three, right? For me personally, I really like this so far. I like EGGS. As you know, I also hold QDevo, and EGGS has similar strategy and goal. It might be a little bit more. It might be like the opposite of QDevo. QDevo is capital appreciation first and then income, whereas EGGS is income and then capital appreciation. So if I were to choose out of three, I would lean towards EGGS, right, as it provides the income and it doesn't want to cap the upside. So I want that NAV appreciation. The fund mandates and strategy comparison. So EGGY, primary goal, high income. How they achieve it is cover call centric strategy for pure income, sacrifice upside, stated downside hedge. Yes. EGGS, primary goal, income plus hedging, sells out the money call spreads, income, buys out the money calls up and has upside. Stated downside hedge. Yes. Right. S&P 500 puts. Right, and then EGGQ, its primary goal is for long-term growth, sells out the money call spreads, buy out the money calls calibrated for upside capture, right? Let's emphasize larger drawdowns because it's growth, right? As much as it can go up, it can also go down just as much. Like management and fee structure, right? Advisor, title investments, serve as platform manager, handling regulatory, operational, and compliance infrastructure. I'm sure you guys see this name a lot. They're pretty much in almost all cover call ETFs, even in like um the big ones like UMax and News, I believe. I'm not sure, but they basically they're like the managers as stated, like they handle all of the sec filings, like putting out new ETFs. They help them with that. All right. Sub advisors, NestEgg ETFs, select concentrated equity portfolio, the what to buy, right? So it's the PMs are these two. And you can Google that, W Cordoba and M Marmis. And then sub-advisors is the Sega Financial. I implement the complex options overlay, the how to it structure. So when I found out on this, for me it was kind of confusing, which I don't really like. I want one whole team together, and it just seems like it's just very confusing. When I was on the website, it just felt very confusing. When I was trying to find their fund prospectus, I had to email, which I found very interesting, suspicious, I guess. It raised alarms. I didn't like that. Why do I have to email you to find out what the strategy is and what your fund information is? Like, no, you should have put that out there publicly. It should be on your website like most other cover call ETF fund. So that's why I'm still on the edge with going in on one of these ETFs. It's a very confusing uh ETF, right? They're it's very hard to navigate, and when it's hard to navigate for just to understand what they do, I don't feel comfortable buying their product, right? I want to be able to know the CEO. I want to be able to like easily find information about your fund, and it gives me the educated decision to understand where your mindset for this for your company where it wants to be at in 1 year, 3 year, 5 years, right? So for me it was a little red flag. So just the FYI, that's personally for me. All right, risk two, the high volatility, the guard myth, right? So volatility versus market, EGGY, eggs, and the S&P 500 benchmark, right? Despite guard marketing, the fund are 30 to 100% to 102% more volatile, right? So the than the board market, driven by the concentrated portfolios. Remember, it holds 10 to 25 stocks. So the benchmark here of a beta, all right, 1, right? So beta 1 is the standard, right? So anything below 1 is less volatile, right? It doesn't swing up or down. It stays very solid. As you can see, your eggs is very volatile, and eggy is just off the charts, right? It's 100% more, 102% more, right? So when you look at beta and it's under 1, it's very calm. You don't have to worry about it. It's a set and forget. But once you get closer to 1 or above it, then it's like, all right, I have to actually open up my app and start tracking it every other hour. You might be stressed from waking up at 2, 3, 4 a.m. You're like, all right, what's going on with the news? What's going on with the market? Because it will affect you since it holds up to 25 stocks. All right, risk two, the beta contraction, right? The high beta view. Some aggregators report very high betas, 1.3 to 2.3. This view likely captures high beta nature of the underlying stock, Nvidia, AMD, Tesla, versus the low beta view, right? 0.55, which is half of the David standard of 1 that we used in the previous slide. Right, other sources like Morningstar report low category relative betas to 0.55. This view likely captures the hedged performance against other funds with options, right? And when I read those two, the conclusion is that the beta is broken and unreliable. The fund's option create a non-linked return. Worse drawdown is a more reliable risk metric. So that was another thing with these ETFs, is because it's so concentrated, you really can't put a finger on it, right? So at the moment, I'm just gonna put them on watch list and just watch how they perform. How the hedge actually works: EGGY and eggs, right? So the market drops 0 to 8%. The fund fully participates in this large loss. The hedge is not active. Market drops 8 to 10%. The S&P 500 put hedge, the S&P 500 put hedge activates to blunt further losses. Right? This is a telltale insurance, not a daily volatility damper. Risk 3, the true cost of ownership. 0.89 net expense ratio at a high explicit cost after the 0.06 temporary waiver. This fee is higher than the fund's entire investment income. The 1-year new fund risk with an inception date of 12/26/24. The fund has no meaningful track record across different market cycles. So yes, they are performing well now, but with such a high expense ratio, I'm just not really thinking it's worth it right now. Again, like I said, watch list, and I'll see how it performs and see if it's the expense ratio is worth it. And then the hidden trading costs, right? It's not great in terms of how liquid it is. It has poor liquidity, it has low volume, which leads to wide bid-ask spreads, creating a high toll for investors to get in or out. So the high bid ask spread is that if you were to sell, chances are you would sell at the lower end of the asking price, so you might lose out. The hidden cost visualized here. See, what this is what I mean: median bid, ask spread, and average daily volume shares. So it's not right. It's not so great, right? Spread is over 5x wider than liquid peers. I'm just using KYDL, so you're paying like 0.32% more, right? It's not a lot. This is not liquid. So again, a lot of these on my watch list, and I'll just see how it performs in the future. Risk 3, the liquidity and crisis, which is on assets under management. Again, just saying, for the 3-month daily volume is pretty low. Assets under management. Again, these are very new funds and they don't have much assets under management, but that's okay. It's still under a year old. We'll see how it performs and we'll see how it goes, right? They're up, like I said in the beginning of the video, they're up and coming, they're rising, and we'll see how well they perform. We'll see if they take any money from other ETFs, right? Because that 10 to 25 stock holding could perform very well, and it will start attracting investors in a downturn, right? We'll see how it does in a downturn. All right, key metrics as of 10/31/2025. Said this in a previous video. EGGY approximate assets under management is about 35 to 48 million, 25k shares, and all of it is 0.89 expense ratio. Year to date has been amazing for them, right? Look at that, plus 27, plus 27, plus 35. Their max drawdowns has been minus 18, minus 22, and their yield is extremely crazy high. So we'll see how their yields hold up and their year-to-date return holds up during a downturn. So right now, everyone is doing well in a bull market, but I also like to see how they perform in a bear market. I'm sorry, bull market. And then exclusive summary, my key findings, right? The yield contraction, high advertised yield, about 20%, or contracted by negative 30-day SEC yields of 0.56, proving distribution or not from income. But so far, because their NAV appreciation has been high, it has been good rock, right? And then we talked about rock. It's just distribution or source from option income. Premiums classified as return on capital is just a tax strategy, not a profit. And then of course we have extreme concentration. I don't really like that they're too concentrated, and their top holdings near 70%. To me, it's too much of a risk. I don't like it, and they have low liquidity risk. So until they can grow it to at least 100 million, I'll keep my eyes on it. Final verdict and takeaway, right? It's high risk, not high income. These are high cost, high volatility concentrated products, not traditional income funds. The hedge is for tail risk only. The yield is a tax strategy. There is no free lunch trade-off. Income and investors trade off cap, upside growth to monetize volatility, all while paying high fees and critically low liquidity, right? Bid ask cost. So who is this suitable for, right? Is not suitable for conservative investors seeking stable income or capital preservation, investors seeking broad diversified market share, short-term or tactical traders due to prohibited bid-ask spreads because this is very it's not liquid at all, investors in tax-exempt account who have no need for tax-deferred rock strategy. Who is it for, right? Highly sophisticated, high risk tolerant investors seeking concentrated leverage like exposure to a volatile basket of tech stocks, investors in a high tax bracket who fully understands and desire a tax deferred cash flow stream via rock. So if you fit into one of these categories, then it might be for you. It might not be for you. At the moment, it is not for me because I do consider myself a semi-conservative investor. It's a little bit too concentrated for me. I like to have both upside and downside. I'm both in income and capital preservation preserve preservers. Okay, I want to protect my capital as I can't get that word out today. I want to protect my NAV, right? I want to see my NAV grow, plus have steady income and growing income. So it's not for me. I am not a short-term or tactical trader. I like to buy, hold, and for the most part, forget about it and just collect the money. I don't want to check my portfolio every day or have to monitor every hour, right? But if you're not any of that and you're the opposite of that, then it's for you, right? You a high risk tolerant investor and you're okay with the concentration, right? Or maybe you're in the high tax bracket. So if it's for you, great. Let me know why you own it. Let me know how it's been working out for you. I love to see people who own it give me their thoughts and opinions. Obviously you have first-hand experience. And subscribe, comment, and like. I hope you guys like this due diligence because it took me a while and I've had this on my watch list for a while. I've been trying to see how they've been performing. Again, I like their income and capital appreciation ETF. So I'll be looking at that. I'll be monitoring all three and comparing them. At the moment, it doesn't fit my portfolio, but after a year or maybe a year and some change, if they continue to do well and we do enter a bear market for some time and they still hold up, then I will definitely get my foot in. So then, thank you for watching. I hope you guys have learned something. Please subscribe, comment, and like, and if you own the ETFs, let me know how it's been treating you. Take care.